Take a look at this. It's the front page of the New York Times from 1929. Buried deep inside is a story most people ignored. A massive piece of legislation called the Smoot-Hawley Tariff Bill. It wasn't law yet, but it was getting dangerously close. On this very day, Congress rejected an amendment that would have lowered import taxes on calcium carbide. 16 senators who once opposed high tariffs suddenly flipped their votes. Why does that matter? Because that small political shift signaled something much bigger, a rising tide of economic nationalism. America was turning inward, building walls around its economy just as the world was trying to reconnect after the chaos of World War I. And the timing is chillin'. This exact story broke on Thursday, October 24th, 1929, the day the markets collapsed. Black Thursday, the day the Roaring Twenties came to a screeching halt. Was it a coincidence? Maybe, or maybe not. This is what sent economists and me down a rabbit hole. Could the growing momentum for this tariff bill have actually triggered the 1929 crash? Or worse, did it turn a financial panic into the full-blown Great Depression? To understand this, we need to rewind a few decades. Before the Great Depression, America's economy was built on exports. Why? Because after World War I, Europe's farms and factories were in ruins. American agriculture and manufacturing stepped in to fill that global vacuum. The US wasn't just feeding itself, it was feeding the world. To keep trade flowing, Washington even started lowering its famously high tariffs and created an income tax to make up for the lost revenue. It was a rare moment of economic openness for America, but it didn't last. By the mid-1920s, Europe had recovered. Their farms were producing again, their factories restarted, and suddenly, American goods weren't as essential. This led to massive overproduction. Too many crops, too many cars, too many goods, and not enough buyers. So, in 1922, America tried to fix the problem with the Ford-Niemeyer Tariff Act. The logic seemed simple. Raise tariffs to protect us businesses. But it backfired spectacularly. Protectionism always sounds patriotic until you look at the consequences. When the US raised tariffs to an average of 40%, Europe retaliated. 26 nations, from Britain to Italy, hiked their own import taxes. Australia, Canada, and New Zealand followed suit. And the result? Farmers, the very people the bill was meant to protect, were crushed. Prices for crops like cotton, corn, and wheat collapsed. At the same time, the cost of their tools, wagons, harnesses, plows soared. Why? Because the tariffs made imported materials more expensive. It was a brutal double squeeze, lower income and higher costs. But this tragedy went largely unnoticed. The rest of America was dancing through the Roaring Twenties. Cities were buzzing, factories were booming, and the stock market looked unstoppable. When people are getting rich, they don't question the system, they worship it. But beneath all that glitter was rot, deepening rural poverty, growing trade, isolation, and a fragile credit bubble built on speculation and denial. Then came 1928. Herbert Hoover campaigned on a promise to save the American farmer. His solution? Raise tariffs on agricultural imports even higher. The idea was to make European goods more expensive and give US farmers an edge. It sounded noble, and it won him the presidency. With a Republican majority in both the House and the Senate, the path was clear. But this was an incredibly dangerous idea. The global economy isn't a battlefield, it's a delicate web. When one country pulls a thread, the whole system trembles. Let's go back to the end of 1928. The stock market is booming, the parties are endless, and nobody thinks the good times will ever stop. But underneath all that optimism, a disaster was brewing in Washington. Because when you mix economic fear with political ambition, policy becomes panic in disguise. Just months after taking office, President Herbert Hoover decided to make good on his campaign promise to protect American farmers. A new bill, co-sponsored by Senators Smoot and Hawley, was introduced. On the surface, it seemed harmless, just a small fix to help the agricultural sector. But here's where it all went wrong. Once Congress opened the door to protectionism, every industry wanted a piece of the action. The bill quickly spiraled out of control. Lobbyists saw their chance. The political thinking was simple. If we're protecting farmers, why not factory workers? Why not manufacturers? Why not everyone? The bill that passed the House in May 1929 was a monster. It raised tariffs on over 2,000 items from butter and potatoes to wool and manufactured goods. A simple plan to help the countryside had morphed into a full-scale retreat from global trade. The average tariff on farm goods alone jumped from 40% to over 54%, and that was just the beginning. When the bill hit the Senate, Washington turned into a feeding frenzy. Lobbyists from steel, textiles, sugar, and shoe industries flooded Capitol Hill. Why the desperation? Because tariffs aren't just economic tools. They're weapons of political survival. Every senator wanted to go home and say they defended American jobs, even if it meant destroying international relationships. What started as a focused bill for farmers ballooned into something unrecognizable. By the time the Senate was done, They had rewritten tariffs on 20,000 different products. The average tariff rate hit nearly 60%, the highest in American history. So why didn't anyone stop it? Because in times of fear, nations often choose to build walls instead of bridges. Now, all that was left was for President Hoover to sign it. The warnings were deafening. Over 1,000 economists signed an open letter, begging him to veto the bill. They predicted it would drive up prices, choke off trade, and provoke retaliation from other countries. Even Henry Ford personally visited the White House, calling the bill an economic stupidity. So why did Hoover ignore them? Because he was trapped. He had built his entire campaign on protecting farmers. Vetoing the bill would make him look weak and like a man who broke his promise. So, in June 1930, against all expert advice, he signed the Smoot-Hawley Tariff Act into law. The market's reaction tells the whole story. After the crash of '29, the market actually started to recover in early 1930. It rose by 50%. Investors were betting that the tariff bill was so extreme, so obviously destructive, that Hoover would have to veto it. They clung to hope even as the logic disappeared. But when it became clear the bill would become law, confidence evaporated overnight. The market plunged, erasing all the gains, and then some. This wasn't just a correction, it was a reckoning. It's like, did the Smoot-Hawley tariff cause the Great Depression? Not by itself. Think of it as the match that lit a house already soaked in gasoline. By 1929, the market was a house of cards. Industries were overleveraged, and ordinary people were borrowing huge sums of money to buy stocks, often with only 10% down. It was a bubble built on pure speculation, not fundamentals. The 1920s had its own version of the dot-com mania, centered around the radio industry. When confidence finally cracked, the whole thing was destined to collapse. The Smoot-Hawley Act was simply the final, devastating blow that turned a market crash into a global catastrophe. The Smoot-Hawley tariff was signed, the markets had plunged, and what followed was not a recession, it was an unraveling. But to me, the more fascinating question? Just what happened at why it got so bad? Why did this one collapse cripple America for a decade, while others, even recent ones, recovered in months? After the 1929 crash, unemployment in the US shot up from 3% to an unimaginable 25% by 1933. That's roughly 12.8 million Americans out of work. Those who still had jobs weren't spared either. Their wages fell by over 40%. But why did the pain cut this deep? Because this wasn't just a financial crash. It was a collapse of confidence. Money stopped circulating. Factories stopped producing. And when people lose faith in the system, even sound economies can't breathe. US GDP fell by nearly a third. To put that in perspective, in the 2008 financial crisis, the one that sent shockwaves across the world, GDP fell by less than 4%. Why is that comparison so important? Because it shows that the Great Depression wasn't just about numbers. It was psychological. It was global. It was existential. The Dow Jones didn't just dip, it disintegrated, collapsing by nearly 90%. From 381 points to just 41. It took 26 years to recover. Imagine an entire generation watching the market and never trusting it again. Now let's talk about the most overlooked casualty, global trade. With tariffs slapped on over 20,000 products, international commerce didn't just slow, it imploded. Between 1929 and 1932, US exports fell from $7 billion to $2.5 billion. Imports mirrored that decline. But why did trade matter so much? Because trade isn't just about goods, it's about interdependence. It's how nations share growth, stability, and confidence. When the US built walls around its economy, other nations responded in kind, and the entire system suffocated. Canada, America's closest trading partner, immediately retaliated with tariffs on 16 US product categories. 1/3 of all American exports to Canada. Britain took a subtler route. In 1932, it built its own club, the Imperial Preference System, trading freely within its empire, excluding the US entirely. But why is that significant? Because the US didn't just lose money, it lost access. Canada began buying from Britain, Australians from their own suppliers. America had isolated itself in a world that was desperately trying to reconnect. Today, most economists agree, the Smoot-Hawley tariff didn't cause the Great Depression, but it absolutely made it worse. A National Bureau of Economic Research study found something fascinating. While industrial production began recovering after 1932, trade did not. Why? Because tariffs distort the flow of recovery. Factories can start producing again. But if no one's buying abroad, growth becomes an echo chamber, demand trapped within borders. And since many smaller countries were even more dependent on exports than the US, their suffering ricocheted back into the American economy. Less trade meant less income abroad, and that meant fewer buyers for American goods. It was a global feedback loop of decline. But again, worsening isn't the same as causing. Tariffs weren't the match that started the fire. They were the oxygen that kept it burning. So, what did cause the Great Depression? That's where John Maynard Keynes enters the story. Keynes argued that the root of the crisis was a collapse in demand. After the 1929 crash, families and businesses stopped spending. They focused on paying debts, hoarding cash. But why was that catastrophic? Because economies live and die on movement. When people stop spending, companies stop earning. When companies stop earning, they lay off workers who then spend even less. This created a downward spiral. Less demand, fewer jobs, lower wages, feeding endlessly into itself. Classical economists of the time insisted the market would correct itself. But Keynes saw the flaw. The collapse was too deep for self-correction. Consumers weren't waiting for better times. They were waiting for lower prices. In a deflationary economy, every day you don't spend, your money becomes more valuable. Why buy today when it'll be cheaper tomorrow? And borrowing, impossible. Because as prices fell, the real weight of debt increased. A $100 loan became heavier every month, crushing both consumers and businesses. Keynes' solution was radical for the time. The government must intervene, inject money, create jobs, and restart demand. America didn't do this then, but modern crises like 2008 or the pandemic reflect that very idea. Massive government spending, not as generosity, but as economic CPR. But Keynes wasn't the only one with answers. Decades later, economists Milton Friedman and Anna Schwartz proposed a different culprit, the Federal Reserve itself. They argued that the Fed failed at its most essential job, keeping the banking system alive. Between 1929 and 1933, more than 9,000 banks collapsed. And here's the terrifying part. Deposit insurance didn't exist yet. So, every time a rumor spread that a bank might fail, people ran to withdraw everything, triggering exactly what they feared. But why did that destroy the economy? Because banks aren't vaults. They're circulatory systems. They lend most of their deposits back into the economy, fueling business, jobs, and growth. But when panic hits, they hoard cash. Lending freezes. Commerce dies. Friedman argued that the Fed could have stepped in as a lender of last resort, providing liquidity to banks when confidence collapsed. It didn't. And why didn't it? Because the Fed was young, timid, and trapped in old ideas about discipline and gold reserves. It saw itself as a guardian against inflation, not as a savior in crisis. So instead of loosening money, it tightened it, turning a market crash into a monetary heart attack. Today, we live in a world built on that lesson. In every modern crisis, from 2008 to 2020, the Fed moves fast, cuts rates to zero, and floods the system with liquidity. It's not charity, it's survival strategy. Born from the mistakes of